Building a dynamic cash flow that can be easily updated for changing conditions and that supports scenario analysis is no longer a luxury item for your business. It has become a necessity. The ability of your company to navigate through these uncertain times and through significant instabilities would solely depend on your ability to keep track of your cash flows and predict future expected cash flow positions. It provides visibility on your ability to provide suppliers, to keep up with your payroll obligations, the ability to settle your expenses, and it also provides an insight on the potential risks that are associated with your cash flow, your future expected cash flow positions, potential risks that are associated with your cash receipts from customers in these difficult times. Receipts from customers tend to lag revenue, and suppliers keep requesting for immediate payment for supplies. So you're probably going to experience cash flow difficulties at some point, but the dynamic cash flow helps you prepare in advance for it and provides a sort of insight to the possibility of that happening in the future. In this video, I will take you through a step-by-step approach on how you can build your own dynamic cash flow model. At the end of the video, I will share with you links to access free templates for cash flow models that could help guide and help you keep track of your cash flows. So let's do this. Determine an approach. Do you want to view your cash forecast daily, weekly, or monthly? I would recommend a daily cash forecast for businesses that are experiencing potential cash shortage, crisis, or risk. You can also adopt the direct or the indirect method in building your cash flow. Now, the direct method schedules your cash receipts from sales and other means of income, less your cash disbursements like payroll obligations, like purchase of raw materials, to get your net cash balance. Now, this method is best suited for short term, where all the actual data are known. The indirect method starts with your net income, add or subtract your net working capital movement. This method is best suited for long or medium term. Like we said, struggling businesses should adopt the short-term forecasting to ensure survival through cash flow crisis. Build a robust forecast. Your cash forecast must be simple, straightforward, and uncomplicated so that it can be used to view key insights quickly. There are so many software tools that are used to model your cash flow, but the most commonly used is the Excel, Microsoft Excel. The next thing you do is collate your historical data that details income and expenses. You review the data to establish a benchmark expectation of future cash flow for line items. It will provide an insight on sales trend, on amount, and recurring expenses, especially the timing of recurring expenses. Build your cash flow model. Start with establishing your cash at hand, which is going to become your opening balance. It is also your closing balance for the previous or for the prior period. Then you project your receipts for the upcoming periods. Predict how much will flow into the organization from cash sales or from cash collection for sales, or from sales of fixed assets, from interest income, etc. So you predict your cash inflows. Remember, do not confuse your cash flow with revenue. Revenue will take cognizance of credit sales
After you have projected your cash inflow, you proceed to estimating your cash outflow. Estimate payment to your suppliers, estimate your payroll obligations, estimate your expenses, your cash payment expenses, estimate your interest payments, and then you deduct it from your cash at hand, your opening balance. After you have done that, whatever balance you have left becomes your closing balance for that same period, which is your closing cash balance.
Okay, so this is an example of what a dynamic cash flow forecast model looks like. Remember, we made mention of the need to determine an approach of whether to view your cash flow model weekly, daily, or monthly. I chose to view mine monthly, as you can see from this model. And we also mentioned the need to collate historical data to guide our forecast trend for cash flow expectations. Now, from this model, August 2020 to December 2020 reflects my historical records, and it was used to forecast the latest estimates for the period of February 2021 to July 2021. Now, this model also starts with the opening cash balance, and then we added our cash receipts, consisting of cash sales from customers, sales of fixed assets, deducted our cash payment to suppliers, payroll obligations to get our closing cash balance. Now, this closing cash balance becomes the opening cash balance for the next month. You can click the link in the description box below to get a free access to this template. Your cash flow forecasts must be modeled to accommodate what-if scenario analysis for planning. This will allow the business to see results of cash flow positions under a range of different future circumstances to enable timely decisions for contingencies. In my cash flow model, I have created an assumption sheet, like you can see here, scenario analysis sheet. And in my assumption sheet or scenario analysis sheet, I have three cases. I have three cases: the life case, the upside case, and downside case. So what I have done here is use the historical data that I have to create a life case assumption. So if we scroll to the right, you'd see the percentages increase or decrease based on historical data. So from August to September, how much did my cash sales increase by, and by what percentage did my cash sales increase? And I have a 25% here. So I'm assuming that in February 2021, using my historical data trend, my cash sales will increase by 25%. Or my cash from my cash sales will increase by 25%, and then it goes on and on like that. And it's colored in black. If you notice, the font color is black because this is formula driven. All my formula driven cells are written or are filled in black, and then the hard coded cells, or the cells where we hard code the numbers, are written in the font color blue. So that's it. So my life case scenario drives from my historical data trend, and then my upside case assumes that it gets better than that going forward. So I'm saying my historical trend, it's going to be better than my historical trend. So I added an extra 5%. Now this you can play with. These cells you can play with based on based on the circumstances surrounding your business and your based on the circumstances surrounding the growth in your business. You'd be able to forecast, is my historical trend going to be sufficient? It's going to get better. And then you also have a downside case that assumes that it gets worse than what it used to be. So I took a 1% cut from my 25%, and I'm saying worst case scenario, my cash sales is going to drop by 24% in February 2021. So it goes on, and then I created a scenario key sheet where you can plug in, you can change whatever scenario you want, and then it recomputes your cash flow for you automatically. Yes, so all you need to do is give each assumption a number: your life case number 1, upside case number 2, downside case number 3, and then you use the choose function in the cell colored highlighted in blue to select what assumption you want to drive your cash flow going forward, or your cash flow forecast going forward. So if you change this to 1, it changes the assumption for you. It changes your cash flow immediately. It drives your cash flow based on your life case scenario, on your life case assumptions. Okay, so let's test the formula. So I'm going to change this to, so this is picking 3, which is the downside case assumption, and giving me 24% here at this point. So I'm going to change this to 2 to see if it gives me the upside case scenario. Sorry about that. I'm just going to click this to 2, and you see it changes to 30%, which is what we have on the upside scenario. And then this 30% drives your cash flow forecast for February 2021. So yeah, so the formulas are working perfectly. Okay, I'm going to quickly walk you through the choose function and how I used it in this assumption sheet. So I leave my I'm clicking this cell 52, 24%. You can see it says equal to, you select the choose function, give me assumption 3 in assumption 1, 2, 3. So I'm saying if this cell is 3, if I put 3 in here, give me the assumption 3 in the 3 assumptions. I don't know if that makes sense, if you understand what I'm saying. But yeah, so what I've done is give me assumption 3. Assumption 3 here is 24%. So because I have 3 in cell 51, it's saying choose H51, choose cell H51 in H24, which is this first one, 25%, H33 and H43. Yeah, so this highlighted cell in blue will drive whatever you have here. Yeah, so that's the choose function. It's very easy to use, and it makes your job way easier than having to do all the scenarios and then having to do cash flow statements for each scenario. That's like the long process. You always have to leave rooms for assumptions. It's never going to be exactly what you expect, so you have to create rooms for assumptions and scenario analysis. That way you can easily manipulate your you can easily not manipulate manipulate is not the word. You can easily get your cash flow to give you the results you want or you expect to see, and this will be perfect for management. It has to be simple, like I said. It has to be straightforward. It has to be something that any user can easily use, can easily update and understand. So you try to make your formulas as short and as simple. I use the choose function because it's very easy to understand and it's short. It's not long and it's not complex. So that's it. Like I said, I'll put a link in the box below for you guys, for you to have a free access to these templates that I used. All you need to do is just update it with your own data, and then you get the results that you want to see. Now that you have a cash flow forecast model that works for you, that is able to provide visibility on the liquidity position of your company or your business, you can now publish key insights for non-finance professionals or key leaders in your business to make decisions for future periods, and it will also help them understand and provide input as to what you need, and provide input as to the assumptions that will drive your next forecasts. Thank you for sticking to the end of the video. If this model came in handy for you, please drop a comment in the comment section below. If you I'd really appreciate your feedbacks. Honestly, I'd really like to know how you use the model and what kind of insights it gave you and all that. It would really make me happy. All right, and don't forget to subscribe, to hit the subscribe button, hit the like button. Thank you for watching. Bye.